Hey, thanks, Jeff. I'm going to move this out of the way for just a second. I was just sitting here thinking, my times have changed a lot. I was at a trial last night, a little small claims court trial. The judge looked at, there were 3 or 4 of us in the room, and he says, Mr. Klein, you're the low number, so you get to go first. And I laughed as I went up, and I said, you know, Your Honor, when I was a kid, that low number meant that I was going to go to Vietnam. So, and the judge actually thought it was funny, so I won my case, and maybe it's because of my sense of humor, I don't know. Today I'm sitting here, and this gentleman right here in full open, public meeting says he's got a pot farm for sale, and I'm looking around going, where's the feds, man? But anyway, times have changed, so, and I'm sure that they will continue to change. Jeff asked me today, and you guys in the back, you can hear me okay, I hope. So Jeff asked me today to talk a little bit about, he doesn't want me to get into full-blown syndication or anything like that. He said, just give us 10 simple things that we can learn to get started. So some of it's going to be geared basic. If you guys have done any kind of multifamily or commercial before. How many have done a little bit of commercial, by the way? Okay. So at least understand some of the concepts, and I assume the rest of you are fairly new to commercial. So there's some basic stuff, but there'll be some gems in there for those of us who've done this for a long, long time, I hope. So a little bit about me. I've been doing this at least 25 years. My dad was a builder, so I started when I was 7, 8 years old working with Dad. But out of college, I did an internship with a property management company down in California. And that worked into a career. I spent 15, 20 years in property management. At one time, I was the regional vice president of a real estate investment trust, a publicly traded REIT. They had 80,000 apartment units. I worked for a developer that had over 40,000 apartment units. So I've looked at a lot of financials. I've looked at a lot of really nasty apartments in my career. I've had a little bit of experience doing this, and actually have been teaching investing in commercial for probably 15, 18 years, so quite some time. So I'm also a local realtor, broker. Anyway, that's a little bit about me. The first thing that you need to know if you're gonna invest in multifamily is the understanding that the value of your property is not based on doing a market survey like you would do in residential. Okay, it's about what income does this produce. Okay, we're going to talk about income, income, and then you're going to talk about expenses, because the only one that I really care about is my net income, or what we call NOI, net operating income. So if you were to take say a $100,000 home, let's say it collects $1,000 a month rent, that would be $12,000 a month of income for the year. You're usually going to take a vacancy out of that. You can see here, you take, I'll just use 1,000. Normally I'd use somewhere around 10% vacancy, but I'll take 1,000 off of that. So my 12,000 becomes 11,000. If you don't have a cash flow analysis with all of the taxes and insurance and all that kind of stuff that you can figure real expenses, you can generally estimate this by taking a third. So a third of the 12,000 is 4,000. Subtract that off of the 11 that I already have left, leaves me $7,000. Okay? If I take that 7,000 and I divide it by the 100,000 that I spent, so the 7,000, by the way, is the NOI, net operating income. And I'm going to divide that by the asking price, and which is 100,000, and that's going to give me a 7% cap rate. Okay? That cap rate is really what you need to understand. You're going to hear NOI and cap rates all day long when you start to invest in these. And so if you're a buyer, you want a high cap rate, right? That means that you're spending less for a dollar of income, right? A cap rate is, for lack of a better term, it's like putting your money in a savings account. If you took that 100,000 put it in a savings account, if at the end of the year the bank gave you $7,000, you'd say you had a 7% interest rate, or we'd say it's a 7% cap rate. If you got $10,000 back, you'd say you had a $10,000 interest, or 10% interest rate, or 10% cap rate. So obviously, if you're buying, the higher the cap rate, the better, because that means you're getting more money on the dollars you invest. If you're a seller, you want the lowest cap rate, because that means the seller voluntarily gave you more money for your deal. So cap rates, one of the things that influences cap rates quite a bit, because for most of us that are new, this is kind of a nebulous concept, right? We're trying to figure out, well, why do we care? Well, there's a couple things about cap rates that you need to understand. Number one, I use what I call the bucket rule. And if I borrow money at 5%, let's say that's the going interest rate that I can borrow a mortgage at, and I turn around and invest that in a 4-cap property, right? We just tattoo stupid on my forehead, because that means I'm going to go broke really, really fast. You can't borrow at 5 and invest at 4 and expect to be around for very long. So you're looking for cap rates, first of all, that are above whatever the mortgage interest rate is. And that changes, right? When interest rates were 10% and I was in college, we didn't even know what an 8 cap was. Today, I cut my little finger off to find an 8 cap in Salt Lake City, but they don't exist because interest rates are much lower. But just understand that those go up and down. Cap rates also are a measure of risk, okay? The really clean property on one street corner as opposed to the one on the other side where they've got a whole bunch of gangsters that are shooting people and dealing drugs and stuff, that you're going to pay more for the one that's clean than the one across the street. And so understand that a high cap rate is also usually it means that there's a little more risk involved with that. It's also related to appreciation, okay? If I'm in a low cap rate market, Salt Lake's a very low cap rate market, it's because we've had such high appreciation, and investors are saying, look, I don't care about income today. All I care about is if I could just hold on to this for a year, it'll double in value, or 2 years or whatever. But that's what investors in Salt Lake are banking on. And so a high appreciating market is a very low cap rate market, okay? Conversely, if you're looking for high cap rates, you're not finding them in Salt Lake City, you're not finding them in San Francisco. You're going to someplace like Peoria, Illinois, where Caterpillar laid off 2/3 of the workforce 3 years ago, and that market's devastated. That's a high cap rate market, right? And if all you want is income, you don't want the appreciation, then you go to a market that doesn't appreciate and you buy higher cap rates. So there's a formula. You can figure out the value of a property if you know the rate and you know the income, the NOI, IRV. You can also figure out the rate, the cap rate, if you know what the income and the value is. And so we do this all the time. And you can also figure out the income if somebody has a property, you know what the value they're asking and you know what their cap rate is. So very simple mathematical formula, and the one you're mostly going to use is the income divided by cap rate is going to equal the value of the property. So everybody wants to know, how do I find these, right? So they're income generated, and it's really, really important that you understand the simple concept that the 1% rule. How many of you have heard of the 1% rule? Okay? So we were always taught that if you go buy a house, you spend $100,000 for it, you need at least $1,000 a month in income, right? In monthly income. If you don't have that, the chances that this is going to cash flow for you is not very good. The farther away you get from that 1% rule, the less likely it's going to pay for itself. Okay? Some people don't care. They just know they're going to double the value in a year, and they don't really care, and that's okay. But most of you are going to look for something that at least pays for itself. A cap rate. Well, if it meets the 1% rule, it's generally going to be in the 6 to 7% cap rate range. That's about what where they end up. The other one that people use, and I don't use this because I use the 1% rule, but you can use what's called a gross rent multiplier, or a GRM. And that just takes the annual gross income and divides it by the purchase price, okay? A GRM of about 8 is about equal to a 1% rule. You can calculate it out if you want to, but it's right close to about an 8. What the GRM says is how many times would it take that monthly or that annual income, how many years would it take me to pay off the purchase price? So obviously, the lower the GRM, if I can pay it off in 3 years with the income, that's a better deal than 12 years. But if you use that GRM, and you'll see it advertised, about 8 and below is about where you should be looking. Okay? 1% rule, again, it works with houses, we all know that. Most people don't realize that it works with multifamily, okay? So, I'll just as an example, this is a fairly large deal here, and I used to manage that years ago. 250 units, if I said the gross scheduled income is 2.4 million, you'd be going, I don't know. It's too big of a number, it doesn't compute, it certainly doesn't look like it meets my 1% rule. But if I take the average rent of $800 a month, and I take the purchase price and figure that at $75,000 a unit, now all of a sudden it makes sense, doesn't it? You can say right away, yeah, that meets the 1% rule by a little bit. So just an understanding that income is really what's going to determine whether your deals work. And just, if I know what the average rents are in Salt Lake City, anybody have an idea, if you had a 2-bedroom apartment right here in Salt Lake City, how much do you think it would rent for today? About 800? Okay. How much?
Depends on the location.
Okay. So it varies from area, right? If you're in Sugar House, what that tells me is that I don't want to pay more than $200,000 a unit for property in Sugar House. If I'm in West Valley and they're collecting $800, then I don't want to pay more than $80,000 a unit in West Valley. What's the average price per unit of property in Salt Lake City right now? It's about 120 to 150, right? Some of the renovated stuff is hitting 200, right? The really nice renovated stuff. But it just tells me that it's really hard to find stuff that meets the 1% rule in Salt Lake City because people are buying for appreciation. They're not worried as much about income, okay? So, small properties can be schizophrenic. And what I mean by that is, you take a fourplex, right? Those of you realtors, you know that you can buy a fourplex for your client, you help your client buy a fourplex. They live in one side, they get an FHA loan, 3 to 5% down, right? They can rent the other 3 units out. They get credit for the income, so it's a great way to get started into your first home. Live in a fourplex, fix it up. When the fixed up, when yours is fixed up, guy moves out next door, you move into that one, you fix it up, right? Rent out the one fixed up for more money, and you can just blow through it. In about a year and a half, you'll blow through the whole thing. You've probably made $100,000 in equity in a year. You go sell that one, or you don't even have to sell it, right? You can just go buy your next one and move through. In 4 or 5 years, your client will probably pay for a $300,000-$400,000 house with cash, just by doing that, and you can sell their properties. But anyway, so the problem is that smaller properties, people can buy those as single-family homes, right? And so they don't always trade at a cash flow value. So what you're finding today is fourplexes are way, way overpriced in Salt Lake City relative to their income. If I go look at a 100-unit building, nobody buys a 100-unit building and lives in one unit and gets a loan for the other 99. So they're not competing with the single-family home market. But anyway, just understand that right now, duplexes and fourplexes are really, really overpriced relative to their income. They're schizophrenic. 10 years ago, 2008, 2009, you could buy fourplexes. Houses were worth less to a homeowner than they were as a rental property. You could buy them for $80,000 and rent them for $1,200 a month or something like that. So those valuations change quite a bit. There's a concept of investing for appreciation versus income. If I use 12% cash on cash or $100 per unit per month as kind of a standard value that I would invest for. So if I find a property, I'm going to invest. This is kind of the standard. If I'm looking for cash flow, I want to make at least 12% on my money, right? Or $100 a month. If I take that $100 a month and I make it $12,000 a year, and let's say I spend $100,000 for this property, but I put an 80,000 loan and I put 20,000 down. So if I take that 12,000 a year and I figure how long is it going to take me at this rate to buy my second property, right? And it's about 16 and a half years, right? My 12,000 a year to get my 20,000 to I go buy the next one. It's a slow way investing in cash flow to get more cash flow, okay? You'll get there. And if you start when you're 25, you'll retire with a boatload of money. But if you're my age and you decide to get started today, you're kind of behind the 8 ball a little bit, and you may have to look more at a value play. Most value plays double in 1 to 2 years. I do it all day long, right? So my 20,000 becomes 40,000 at the end of the year when I sell the property, right? I could pay taxes on half of the 20,000. I got my 20,000 back. I could take 10,000 and go buy a cash flow property every year or every other year. So value play is something that, and the market in Salt Lake City today, this is a value play market, okay? You are not investing for cash flow today, you're investing for value play. This one's a very interesting concept. How much is a dollar worth, right? So if you raise your rent $1 per month, right? You say, well, yeah, it's going to take the value of my property up a little bit, right? The question is how much? How much does it go up? And you wouldn't think very much, right? My rent goes from 1,000 to 1,001 next year. Well, if I drove out there to my tenant to have him sign that new lease, he's thinking, what the heck are you thinking? That's $12 a year. You drove all the way out here for $12 next year, right? And literally, you know, I can't take my wife to dinner at McDonald's for $12 a year. You know, it's almost worthless. But watch what happens when I capitalize it. Using the same formula, NOI divided by the cap rate equals the value. So we're going to assume $12 a year is my dollar per month. At an 8 cap equals $150 of value, right? You raise your rent $1 per month, you get $150 of added value back, right? Is that incredible? Okay, watch what happens though if you're really in a 6 cap market, because we know Salt Lake's not an 8 cap market, and it's probably not a 6 cap market, but the same number in a 6 cap market is $200, right? And in a 5 cap market, which is where Salt Lake probably is right now, it's $240, right? So if I'm going to go buy a property, I'm going to spend $15,000 a unit to fix it up, and I'm going to put it in, you know, raise my rent $200 a month. Do I want to do it in an 8 cap market, or do I want to do it in a 5 cap market? So that's why Salt Lake City is a value play market. Nobody is investing for income. They're all investing for appreciation, because that's what the market's telling us to do, okay? You wouldn't want to do this in Peoria right now, or Rochester, or, you know, Memphis, wherever the, you know, Oklahoma City, wherever the really crappy markets are right now. Those are cash flow markets, and you're probably going to invest for cash flow. We're going to put them all together for just a second. How many of you have heard of the term ideal? Real estate's the ideal investment. Okay? So ideal bases your valuation based on income, depreciation, equity, appreciation, and leverage. So when you buy a flip, you're only banking on one thing, right? Appreciation. We're going to make it go up in value. Income property gives us all 5 of these ways that I can make a little bit of money. The problem is, how do you sell that? Because I used an example earlier at a 7 cap, right? How many of you'd want to buy my 7 cap property today, right? How about if I bought it and I get you to put up the 20,000 and I gave you half of the income back? So now you're getting 3.5%. You still excited about that? Not as exciting, right? 3.5% on your money. Okay. So what we do is we're going to take that same property, and I'm just going to go through the numbers really quickly. But if I take the income, if I put $20,000 down on this property, it's going to work out to be about $115 per month of income. Okay. I'm going to take my tax benefit, and without taking the time to explain to you how the depreciation works, it's going to be about $85 a month. Okay. By the way, if anybody else, when we get done, I'll give you my email address. If you guys want to send me an email, I'll send you a copy of my slides if you want to do it that way. So depreciation's worth another $85 a month. You don't get that when you're flipping, right? Equity, you've got a tenant that's paying down your loan every single month. That's worth $76 a month. And then we have appreciation. Let's say the appreciation rate is 5%. It's much higher than that in Salt Lake City right now, but even if it's 5, which is kind of the national average over time, that's worth $416 a month. Okay? This is what it looks like. This is your total monthly benefit. Notice that the appreciation rate is almost 4 times what your income is. Okay? Is there any question why people invest for real estate based on appreciation and not the generally accepted is I'm going to buy this and get monthly income, and that is absolutely your ultimate goal. But to get there, investing for appreciation is the way that's going to get you there the fastest. If you take and add all that up, your monthly benefit is $692 a month. Okay? If I take and times that by 12, I get $8,304 a year. Divide that by the $100,000 I spent for the property, it's about 8.4% or 8.3.5%. Okay? But if I only use the $20,000 I put down, so I'm using the leverage on this thing, watch what happens to it. Okay, I now have a 41% rate of return on my money, and it's because I included all the benefits of investing in commercial real estate. And so I could advertise this as a 7% cap rate, and I'd get 1 or 2 of you to put your hand up, right? How many of you want to put up the money on this thing and get 20.5% rate of return, right? It's a huge investment deal, and that's the beauty of investing in multifamily. Okay, type of markets. We talked a little bit about appreciation markets. This is from the House Price Index report. Any of you guys seen that at all? A few of you have looked at it. Okay, it talks about high appreciation markets, low appreciation markets. The highest market is the darkest up there. It's Idaho, by the way. It's 13.5% right now. Anybody trying to do deals in Idaho and you're wondering why all of a sudden it got harder and harder? Well, that's why, right? Because the appreciation rate is so high. Nevada's second, and I think Utah's third, right? So if we're trying to do deals in this little area, okay, we're certainly not finding 8-9% cap rate deals, right? We're investing for value plays in all those markets. If you wanted a cash flow market, what about Louisiana at 1%, right? I talked about Mississippi, Illinois, so looking at the appreciation rate is going to tell me where I need to go, how I invest for what it is that I have in mind, right? If I want cash flow, if that's what my investors want, is to buy something and hold it forever, I can get that today. I just have to know which markets to go to, right? And if my investors want a quick, appreciation bump, sell it, move on to the next deal, I also know where I can go to find those too. So the important thing is we sometimes think we have to get into this at the bottom of the market so we can let the appreciation of the market take us up. If you know what you're doing, when Utah, 8 years ago, we were investing for cash flow in Utah, okay? It's not that I'm just a value guy all the time. I just let the market tell me what to do, and I'm smart enough to listen what it's telling me, because no matter how smart I think I am, I'm not smart enough to outsmart the market. It's going to do what it wants, and I have to follow. And so anyway, that's how we find markets. Most of the markets, if you go coastal side of either the Appalachians or the Rocky Mountains, if you're on the coastal side of those are generally appreciation markets. They're value play markets. They're the first to come out of the recession. Okay? And these are rules of thumb, and sometimes it changes. If you're in this middle area, some people call it flyover states, the Rust Bucket, right? They're markets that they're not based on high tech. They're not based on, they're mostly, they build tractors, they have farms, they build tractor tires, right? They build automobiles, but that's where you're going to generally find more of your cash flow type properties, cash flow type markets. So just understand, an overview of some of the things we look for, okay? I also look for emerging markets, okay? the red one is Salt Lake City. The 9.5, that's the 5-year number, and I took it and divided it by 5, by the way. So it was 45 or something like that. But that's what it's averaged. Salt Lake's averaged 9.5% appreciation over the last 5 years. The 1-year number was 7.7, okay? And then I took the quarter number and times it by 4 so I could annualize it. Anyway, it came out 6.76. Can you see a definite slide down? It's not an emerging market, is it? On the other hand, if you look at Albuquerque, which is the kind of the turquoise, right? Look at what's happened with Albuquerque. That's the difference between investing in an emerging market versus a declining market. Now, I'm still going back to some of these declining markets. I'm finding deals in Salt Lake City today that I couldn't find 2 years ago because things are starting to settle down a little bit. But they're all value play deals, right? I can go to Phoenix. I found a couple of deals in Tucson this weekend. Same thing. They were up. They're coming back down. Prices are becoming reasonable, and I can find a value play deal there, but I'm still not finding cash flow deals. On the other hand, Oklahoma City would definitely be a cash flow type market right now. Okay, cap rates have all the answers. All right, if my cap rate in my property is between 5 and 6, right? Remember, we don't go below 5 because that's kind of that's the floor I draw because of the mortgage interest rates, right? So 5 to 6 is a pure value play market. If I'm going to invest in a value play market, I need at least $200 a month rent increase to make that deal work. If you're looking in Salt Lake City, that's what you're looking for, is something that it's probably going to be a 5 cap, and you're probably going to need at least 2 and maybe $300 a month, depending on how much you put into it to make the deal work. Okay, between 6 and 8, it's kind of a tweener market. Most of you getting started would probably want to invest in a tweener market because the 5 cap markets are so competitive that you're going to look for a long, long time. I guarantee you'll eventually find a deal here, but it might be 2007 after the market's crashed. I'm just joking, but a tweener market allows you to go in. It's still a good, viable market. You probably only need $100 a month rent increase in a tweener market. Because again, if you're making 7% on your money, it's probably not going to get you to the 12% cash on cash you need. If I can find a market that's between 8 and 10%, those are cash flow markets. I can't syndicate cash flow in those markets because I have to somebody else puts up all the money and I want to take half of it and give them the other half. And so I still have to have $100 a month in those markets, but that's to increase the NOI over the time so that I'm getting them up to the cash on cash that they're looking for to hold it long term. And then if I'm above 10, those are my, you can syndicate. If you can find a 10% cap rate property somewhere in the U.S. today, your rate of return, your cash on cash is going to be 25 to 30% cash on cash. Most people will take that and accept it. If I say, look, you put up the money, we'll split the cash on cash on this thing, forget about the appreciation or whatever else, but just the cash on cash is going to approach 30%. And if I give somebody 15% cash on their money, they're usually willing to jump in and invest with me. So the last thing I want to leave with you is that this is a team game, okay? Especially if you guys decide to syndicate, okay? I can't tell you how difficult it's going to be. Oh, there we go. Ultimate team sport, right? Sorry for those of you who vote for the school down south, but those of you who decide to syndicate and you think, this is Utah, we're all doing it ourselves, guys, right? And so we're gonna do this ourselves. First of all, you find a deal, you put it under contract, and then in the due diligence period, which is about 4 weeks, you have to go walk every unit. You have to find a property manager. You have to go secure your funds, right? You have to call all the people that suggested that they would invest with you and secure your gap funds or your limited partners funds, okay? And you got to do that all in 4 weeks, okay? And in the meantime, you're not putting out a couple $1,000s earnest money. Your EMD is $15,000, $20,000, $30,000. Okay, your inspection is $5,000 to $10,000. Your PPM that you have to produce is another $15,000. So I have just found and I've got a ton of experience in doing this, and that will give me an ulcer faster than anything else. To have 30 days to get all of that done. So what I'm telling you is, don't think that you need to do it all yourself, okay? If you guys are looking to get started, even if it's fourplexes, there's a lot of things that you can get, you know, that will sneak up and bite you if you're not really, really careful. So I'm strongly encouraging you guys, if you decide to go down this road, to make sure that you get some help somewhere. I don't care what that is or who you talk to, but make sure you find somebody that knows what they're doing that can help you with this stuff, because there really is, it becomes much more complicated than just flipping a house. So that's all I have. So not legal advice, not CPA, I'm not a CPA, I'm not trying to give you tax advice or anything like that. But I wrote an article, and I'm just looking for a couple of people to give me an opinion on it. I think I only copied 8 of them. I figured it'd be a slow day because of all the snow. There's 8 of them here. If you want to grab one on the way out, I'd love it if you read it. Send me an email with your opinion. They're just right here on the table. If you'd like a copy of it, and there's not enough left, just grab one of my business cards. Send me a quick email or a text that said I'd love a copy of it, and I'll be sure to get you a copy of it also. It's really about, should you buy today? Should you sell today? Or should you just keep what you have, right? It's a question we're all asking right now if we have multifamily. And so I took a stab at analyzing, you know, buy, sell, or stay. So with that, thanks very much for your time. I really appreciate the opportunity.